stop watching the headlines for a second. Picture this. It's the late 1990s. A warehouse manager named Tom clocks in every morning. Same building, same shift, same paycheck structure. Nothing glamorous, nothing viral. But the deal is clear. Work shows up. Pay shows up. The future feels boring in a good way. Now cut to today. Meet Maya. She has 3 income streams, 2 apps on her phone that decide her schedule, and benefits that technically exist, but vanish if her hours dip for a week. She is officially employed. Her calendar is full. Her bank account is not. Here's the strange part. The data says the job market is strong. Employers say they're hiring. Politicians point to charts going up and to the right. And yet, people like Maya feel more fragile than workers did decades ago. That's not a contradiction. That's the system working exactly as redesigned. One grounded reality most people don't realize. Job counts can rise even while job quality quietly collapses. Another, working more hours across more roles can still leave you poorer at the end of the month. And here's the dark joke nobody laughs at. Congratulations. The economy created jobs, just not stability. Now wake up. It's January 21st, 2026. Here's the accusation, stated calmly. The U.S. job market didn't suddenly break. It was slowly re-engineered, so the numbers look healthy while the experience feels broken. The failure isn't about effort or character or work ethic. It's about incentives. The system learned how to optimize for job counts instead of job security, for flexibility instead of bargaining power, for speed instead of sustainability. This isn't a rant, it's an investigation. We're going to walk through how this happened, step by step. No villains required. Just mechanisms doing what mechanisms do. First mechanism, think of it as a mirror that flatters. Meet Linda. She runs HR for a national retail chain. Her job isn't to fix society. Her job is to keep positions filled and labor costs predictable. When demand becomes uncertain, she doesn't fire people. She fragments roles. One full-time position becomes 2 part-time positions. Benefits shrink, schedules rotate, headcount rises. On paper, employment improves. In reality, stability evaporates. The system rewards what it measures, and what it measures is the number of jobs, not the strength of those jobs. It's like judging a bridge by how many planks it has instead of how much weight it can hold. You can add planks all day and still collapse under pressure. This is why official employment numbers can improve while workers feel worse. The mirror isn't lying, it's just flattering the room. And once counting replaced bargaining, the next shift followed naturally. The treadmill wage, meet Eric, mid-career, educated, employed. He gets raises, real ones. They're celebrated during performance reviews. But every year the finish line moves. Rent resets faster than pay. Insurance costs adjust without asking. Interest payments quietly expand. His income rises, but his footing doesn't. This is the treadmill. Wages don't exist in isolation. They compete with prices that now reset more often than salaries do. When essential costs move faster than income, raises lose their meaning. Add variable schedules, performance pay, and income tied to algorithms instead of contracts, and earnings stop feeling solid. Imagine filling a bucket while the drain keeps widening. You're not lazy, you're not bad with money, you're pouring into a system designed to never quite fill. That's why a raise can be real and still feel useless. And when pay loses its anchor, people adapt. They stack jobs, they accept flexibility, they trade certainty for survival. On paper, this looks productive. In real life, it feels exhausting. So here's where we are. The job market looks strong because the scoreboard was redesigned. Participation matters more than security. Motion matters more than momentum. Nothing here requires a conspiracy, just incentives, time, and silence. If this makes you uncomfortable, it should. Because we've only described the surface mechanics. The deeper forces are still underneath, quietly shaping behavior, expectations, and the future of work itself. If the first crack in the system was how jobs were counted, the next crack came from how risk was reassigned. Not eliminated, reassigned. For most of the 20th century, risk sat higher up the chain. Companies absorbed demand swings. Governments absorbed shocks. Workers traded upside for stability. That arrangement didn't collapse in a crisis. It was dismantled quietly. Let's talk about how. Meet Carlos. Carlos works in logistics. He's technically independent. He owns the risk of slow weeks, fuel costs, maintenance, and downtime. The company owns the platform, the pricing model, and the customer relationship. Carlos didn't lose a job. The job lost its obligations. This is the shift most people miss. Modern labor markets didn't just create flexible work, they externalized volatility. When demand fluctuates, companies no longer smooth the shock. Workers do. Income becomes elastic. Schedules become provisional. Benefits become conditional. From the system's point of view, this is efficient. From the worker's point of view, life becomes unpredictable. The metaphor here is simple. Imagine a ship in rough waters. In the old model, the hull absorbed the waves. In the new model, passengers are handed buckets and told to help bail. Employment still exists. Risk just changed seats. Now here's the myth that keeps this model socially acceptable. The myth says flexibility equals freedom. Let's slow that down. Flexibility without bargaining power isn't freedom. It's optionality for one side and uncertainty for the other. Meet Rachel. Rachel works remotely. She has freedom over location, but not over pricing. Her pay rate adjusts faster than her expenses. If she pushes back, the platform doesn't argue. It replaces. This isn't exploitation in the old sense. It's something colder. Markets with oversupply don't need coercion. They rely on substitution. And here's what the data would show if you lined it up properly. Periods of high labor flexibility often coincide with lower wage stickiness, weaker benefits, and faster income volatility. Institutions like the Federal Reserve and the IMF track pieces of this, but no single metric captures the lived experience of instability. That gap between measurement and reality is where frustration grows. Now let's introduce the structural shift that locked this in. After decades of inflation shocks and financial volatility, policy quietly prioritized price stability and capital mobility. Labor stability became secondary. This wasn't a vote, it was a framework. Global supply chains expanded. Labor markets became more competitive across borders and platforms. Firms optimized for resilience to shareholders, not predictability for workers. The incentive changed. If labor is treated as a variable cost instead of a long-term asset, then volatility isn't a bug, it's a feature. And this leads to another myth worth dismantling. The myth that unemployment numbers tell you how healthy workers are. They don't. Low unemployment can coexist with high anxiety, declining trust, and collapsing long-term planning. People may be working while postponing children, home ownership, or savings because the floor beneath them feels thin. Employment answers the question, are you producing? Stability answers the question, can you plan a life? Those are not the same thing. So when people say the job market feels broken, they're not saying jobs vanished. They're saying the social contract dissolved. Work no longer guarantees predictability. Effort no longer guarantees progress. And time no longer guarantees security. This is not because people changed. It's because the system stopped promising those outcomes. And when promises disappear, behavior follows. People hedge, they distrust, they burn out quietly while the charts stay green. That tension between what the system measures and what people feel is where the real fracture lives, and we're still not at the deepest layer yet. By the time a system stops making sense emotionally, it has usually already failed psychologically. This is the part most charts can't show. Meet Hannah. Hannah isn't unemployed, she isn't underqualified, she isn't disengaged. She's something newer and harder to measure. She's cautious. She delays decisions. She avoids long commitments. She keeps exits open, not because she wants to, but because she learned that stability can be revoked without warning. This is what a broken labor market looks like at the human level. Not panic, not rebellion, quiet withdrawal from trust. For decades, work functioned as a social contract. You gave time, effort, and loyalty. In return, the system offered predictability, maybe not wealth, but continuity. That contract wasn't written into law. It lived in expectations. When those expectations break, people don't stop working. They stop believing. Psychologists would call this learned uncertainty. Economists might call it risk adjustment. Sociologists would call it erosion of institutional trust. Whatever the label, the result is the same. People stop planning long term. They choose liquidity over roots, flexibility over mastery, side options over depth. This is why burnout feels different now. It's not just exhaustion, it's disorientation. Now let's answer the title directly. Why does the U.S. job market look strong but feel broken? Because the system measures participation while people experience precarity. Because incentives reward motion instead of momentum. Because risk was pushed downward while stability was quietly deprioritized. The market is doing what it was optimized to do. The feeling comes from what it no longer guarantees. So what happens next? There are 3 realistic paths forward. Not predictions. Scenarios. The base case. In this path, nothing dramatic breaks. Employment remains high, flexibility expands further, more income becomes variable. The system stays strong on paper, while trust continues to thin. The trigger to watch here is normalization, when instability stops being debated and starts being accepted as permanent. The better case, here, institutions slowly respond to pressure, not out of generosity, but necessity. Firms rediscover retention, policymakers experiment with stabilizers, benefits decouple slightly from employment status. This doesn't restore the old world, it builds guardrails for the new one. The trigger here is labor scarcity paired with political pressure. When replacement stops being cheap, stability regains value. The worst case. In this path, volatility compounds. A shock hits households already stretched thin. Participation remains high, but trust collapses further. People work more and believe less. This isn't a crash, it's a grind. The trigger is a sustained mismatch between income volatility and essential costs with no institutional response. None of these paths require catastrophe. They require inertia. So where does that leave you? Not with advice, not with optimism, not with despair, with clarity. Understanding the system doesn't fix it, but it does restore something important. Orientation. When you know the game changed, you stop blaming yourself for playing it differently. That's the quiet power of financial history. It doesn't shout, it explains. And when systems fail quietly, explanation is the first form of resistance. If this perspective helped you see the job market differently, that's what the quiet market is here for. No hype, no noise, just calm analysis of how systems really work. In the next episode, we'll look at another place where the numbers look healthy while the foundations quietly crack. Sources referenced for this analysis include the Federal Reserve, Bureau of Labor Statistics, FRED, IMF, and BIS. This content is for educational and informational purposes only. Nothing here is financial advice. Thank you for listening.